So, welcome back, everybody, to part two of the Payments Leader Show. Absolutely delighted today to have Esme Wilson. Hi, Esme. How you doing? Welcome back. And Phil Harding as well. Welcome back.
Thank you very much.
So today we're particularly talking now about the relationship between an investor and a PE investor on the one hand with a portfolio company. And what's exciting today is that Phil is actually responsible for the commercial elements and the revenue within a portfolio company. Now I'm going to put this out there that many people would see the investor relationship. We can see it as somewhat the perception would be it can be an antagonistic one, it can be a difficult one. And we're going to show you today, I hope, he says, that actually, in the true sense of the payments industry, you can actually have an effective partnership where actually everybody does grow together, everybody is successful. So I wonder if we could start with you, Esme. What is your expectation as an investor of your role, very specifically? Just if you to give me three things that you are going to do, yep, as an investor.
I think to be the obvious one is firstly bring capital to the situation, but kind of seriously, I think more importantly, I think is, and we touched on this earlier in the show, but being able to bring previous experiences of what's gone wrong and what's gone right to other opportunities to the table. And I think the third one is most importantly, I think bringing a network to the company. So for example, as Phil mentioned, Cashflows have just launched a Shift product. It's very innovative, acquiring bin sponsorship products. I haven't seen any other companies doing this, so I don't have, a lot of experience of, how they can do this better. It's doing very well already. But what we can do is, we've worked with lots of companies, lots of payment companies in very different capacities. So we can bring that network of people we've looked at who maybe we looked at investing in the past, maybe they're partnered with one of our other portfolio companies. Sure. They were probably all customers for Cashflow, so we can just kind of bridge those gaps and make that connection.
Wonderful, wonderful. So Phil, what are the three things that you and Cashflows particularly bring to the relationship?
So I think for the overarching element to this is mutual success, right? Both companies, both Cashflows and obviously Pollen, they want Cashflows to be a success. So that's absolutely fundamental. So I think we will bring to that relationship, I suppose, expertise around payments, an opportunity to build and drive cash flows and make them as successful as possible. I think doing that in partnership and having that mutual success, if you get an investor and then portfolio company, as long as that's fundamental, as long as it's not a them and us, which it absolutely isn't. And I'm sure there must be situations where it is, but I think it's not them and us, it's a mutual objective. How do we be as successful as possible? And that just underpins everything. I think everything else follows from that.
Okay. So Esme, back to you. Tell me what you don't bring to this party then. Tell me what you don't bring to this relationship.
I think we don't bring prescription or an instructiveness. I think, a lot of the analysis we do, we have to bear in mind it has come from kind of a very different environment, and it's very easy to analyze in Excel and numbers and that kind of thing, what happens. But then there's just kind of a know-how and knowing, especially in terms of things like contract negotiation, that kind of thing. We aren't really we're on kind of still negotiations, but it's a totally different war room, if that makes sense, or partnership. So there's a lot of practical knowledge that we'll never know. So making sure we just kind of bring advice on what the analytics say, but not telling people what to do, because we have to be realistic that a lot of us haven't been actually working at that company, so we're not going to pretend that we have.
Okay. And Phil, what do you not bring, and what does Cashflows not bring to the party?
So we cannot sit and wait there and be instructed. So it's almost the exact other side of that. You cannot have a portfolio company sit and wait for the investor to tell them what to do. They are there to advise. They are there to support in so many different ways, which we can go into. But ultimately, the decision making, the direction, the strategy, the people they choose to lead that business, all the way down to every element of that is down to that portfolio company. They can't sit there and wait for instruction.
Okay. Wonderful. So what we've just defined is what your roles are separately. What about, and I'm fascinated to do this now, bringing this together now. How does that actually operate? Let's just start with, say, let's take a quarterly cadence. Yeah. So
Yeah.
how would the quarterly cadence work and the interactions work on a quarterly basis? And then perhaps we could dive into what that looks like on a week or a monthly basis. I'm fascinated, as you can see, by the different dynamics and when that actually happens in real life. Yeah.
Yeah, I think on a quarterly basis, the board will meet quarterly, and that is quite a long, involved discussion where we really discuss everything. So from key risks, commercial successes, new initiatives, the plan for the next quarter, and that can be kind of a multi-hour session where you have the leaders of the business and also the investors. But then I think it's hard to kind of be as prescriptive what happens on a monthly basis. I think we personally have quite a pragmatic approach. Sometimes if there's very exciting new projects being launched, we'll meet kind of every couple of weeks to get an update, talk about it, because that's relevant to that point in time. And that kind of tends to be a bit more ad hoc or as and when needed, because also we understand that our portfolio companies have jobs to do, especially if they're selling new products. So the last thing we want to do is be putting more time in their calendars. So I think it's a very case by case assessment. And some weeks we might meet multiple times. Some weeks we might not meet at all, or have like a quick 5-minute phone call. It really varies.
Okay. And for you, Phil, obviously running the business and making things happen is vital.
Yeah, aligned really. So
Yeah.
I think it's really important to have the quarterly cadence that's more formal. And I think to Esme's point, that's where you go through, any areas of risk, the financial performance of the business, the strategy, the go-to-market, all the next initiatives, etc. And I think having that quarterly where you do take an extra bit of data, and even from a cash flows perspective, that's important for us because that gives us the opportunity. It's manic, right? All the time you're running around and you're driving the business forward, and there is a danger sometimes it can be reactive. This gives everyone an opportunity to get their head above the parapet, take stock, understand where we're at, understand where there might be elements that we need to do better, and understand where there are elements we want to double down on because it's working. So I think that quarterly cadence and a bit more formality is really important. I also absolutely subscribe to then being far more flexible when it comes to more monthly meetings. So we will submit monthly board papers, which again is fairly consistent in the approach. So it doesn't create massive amounts of work internally. In fact, what we make sure we try and do is almost the replication of the board papers that we submit, we also use for our own internal commercial board. Okay, so there isn't this duplication. And that's critical because the way we're running the business internally should not be different to the way we portray the business to our investors. It should be absolutely loads of synergies there. So that is important from a monthly perspective. And then I love the whole ad hoc piece. Like, so great. Esme and I probably spoken, seen each other about 3 or 4 times in the last 2 weeks. We probably spoke a month prior to that because we've been looking at go-to-market. We've obviously been looking at this. We've been looking at certain key opportunities that Esme's introduced us to. So I think the ad hoc ability, which is specific and helps drive certain elements of the business, is fundamental and key and really valuable.
So what I'm hearing though here is, I would call it good contracting in terms of expectations, good contracting in terms of communication, because which allows both sides, I suppose, to frame things well, but also I'd imagine bringing up conflict, bringing up disputes, bringing up situations, actually say we can talk this through like adults because we've framed what our roles are and also whose responsibility things are. Is that the sense I'm getting with how this partnership works?
100%. And you call out a really important point there. And again, this is absolutely critical because I suspect in certain relationships, challenge can almost sometimes be perceived in certainly other organizations I've seen, is it then become them and us.
Yeah, indeed.
And I think as cash flows, we have a responsibility to welcome challenge. I think challenge is always done from an area of support. It's always done with how can we think about and make things better. It's always done with, actually, principally over there, we've seen X, Y, and Z. Have you thought about this over here? So I think challenge is such a massive key area because what we don't want is us just to present back on our business oh, that's good, that's brilliant. Oh, why don't you do a bit more of that over here? We want to be challenged. We want to be supported and challenged in areas we might not have thought about, or areas of which there is experience elsewhere. So I think that is critical, but you can do that if you have trust between the two organizations. If you don't have trust, you don't have roles and responsibilities, you don't understand, I suppose, the cadence and the operating rhythms, it can then creep into, is there them and us mentality?
Yeah. So obviously I do a lot of work at board level and engage in executive leadership teams, etc. And I'm usually just trying to bring very smart, siloed parts together to try and get a common culture and those sort of things. The basis of all that, you've mentioned already there, Phil, is trust. But I think something that precedes trust is psychological safety. Yeah. If a challenge, if I've got psychological safety with you as a leader or with you as an investor, then I'm thinking I know that challenge is coming from a good place. What efforts are made to create psychological safety with, you say, an air of support, I think was the word you used there, which is so what that's a proactive act.
I think most private equity funds typically have investment horizons of 5 years, but they can also go longer for companies that are at very exciting stages in their growth story. And I think, given that most investors do that, once you make the initial partnership, you're committing to be by their side and working together long term. And having that flexibility to support them throughout their growth journey. I think cash flows is a really good example of, in the last couple of years, they've been unlocking exceptional growth, particularly in some of the innovative products that Phil's been touching on. So we kind of want to be there for that next term and help them realise it. And I think that's it's a commitment of time from our company to, it's not these aren't short-term investments, that it's not a very liquid market, private equity. So that's kind of a vote of confidence that, we're not going to go anywhere until you've, realised a really stellar part of growth.
Wonderful. So obviously all of this is driven by, with the payments industry, and talking about the shift from the last 15 years, just sort of something that's been seen in the background to it really has become a headline in every way, and it's driven by the innovation. So Phil, you mentioned a number of interesting and things you've been working on the last 18 months, particularly the shift product. Perhaps you could just bring that to life a little bit more, and how does that serve the and enhance the payments industry as an innovation?
Yeah, happy to. So there's probably two elements of shift. There's payment facilitation, and then there's acquiring and sponsorship. And each of them, almost, if you look at almost the Richter scale of ownership, if we think of the journey ISVs and ISOs have been on over the last 5 years, what we're bringing to market is almost more ownership along that payments journey. So if I bring that to life from a payment facilitator perspective, if we think in the US, for all the payment facilitators that operate in the US, 43% of them are ISVs. In the UK and Europe, only 8% are ISVs. So there is a gap between ISVs transitioning into payment facilitation. Now, payment facilitation is essentially, it's a master merchant taking payments on behalf of their sub-merchants. So there is a gap there between that transition. Now, that's because of a number of things. It's incredibly complicated. Regulation, tech build up front to operate. So you get to a point where we've got a 3-year tech build. You've got to get licensed with the FCA. You've got to be licensed with the schemes. Oh, it's too much hard work. We haven't got the risk and compliance knowledge to do it. Therefore, let's carry on operating in where we get some value out of payments, but we are by no means maximising the payment valuation. So the market has introduced a concept of payment facilitation as a service, and we're launching this with a partner of ours, where essentially we can say to an ISV, don't worry about building tech, we'll give this to you. We've built it off the shelf, it's modularized, we're at our partner card stream. Here's a tech. So rather than a 3-year build, you can have it in 3 months. And don't worry about licenses. Use our licenses from the start. So start to operate like a payment facilitator in 3 months. And then over time, you can start to apply for your licenses. As elements you want to build yourself.
Move along this.
Exactly that. And it means you can monetize almost immediately. Now, some of the really interesting elements to that, think about customer experience from boarding perspective. Today, you would board for your software and then you chuck over the fence to an acquirer to board from a payments. That can take much longer. There's a disconnect. From a commercial perspective, pay for your software, pay for your payments. Well, why don't we bring those two together and be creative? And then what's really interesting is from a valuation perspective, if you become a fully fledged payment facilitator, you own your merchants, therefore you own the value that comes from payments, and that can go towards your valuation. So all of these elements make it really, really interesting to help bridge the gap from ISV only to payment facilitation. When we then think of the second side of shift, that's then almost the next iteration, which is acquiring bin sponsorship. Now, again, what's really interesting is this is really prevalent worldwide, except the UK and Europe, and that's because it's really complicated from a regulatory perspective. So we've spent the last 2 years understanding with the schemes, with the SCA, with DMB, across UK, across Europe, how does this actually operate? What needs to be in place from a risk compliance perspective? Because the acquirer is still liable. So if something goes wrong, we are still liable, and yet we have less and less visibility of what's happening because we're essentially enabling other organizations. So I'll give you a great example. We went live for the first acquiring bin sponsorship in the UK week before last with M-Swipe. They are an enormous acquirer in India, 800,000 merchants. They bought about 20,000 merchants, which is significant, right? They're far bigger than we are. They came into the UK market, they did an RFP. Every response was, yeah, we'd love to work with you, but in an ISO model. So you manage a customer, you give out your terminals, but we will take it from there. Now, M-Swipe was saying, well, look, we're a fairly new acquirer, therefore our technology from a processing perspective is key. Our boarding is really strong. It all links in with our terminal proposition. It's end to end. If we have to give up 3/4 of that, we're actually losing our competitive advantage here. The only other option they had was to become a fully fledged UK acquirer, and that takes 5 years, exceptionally costly, and they don't know the market, as well you know. So we worked with them and said, well, look, why don't you use our licenses? So if you think of this in a practical term, M-Swipe will board the merchants, they will underwrite them, give them all the technology, they will then process those transactions, all of that information they will send into the schemes. But at that point, the schemes have to pay an established UK licensed acquirer. So that's where we come in. We've opened up bins on their behalf. We receive those funds, we pay them back, they pay their sub-merchants. Now, we obviously need to make sure they're operating exactly how we would. So there's all sorts of data flow that we've helped build that risk and compliance framework. But it means they've managed to get to the UK market in 8 months, not 5 years. And actually, we think we can now condense that journey down as well. So we're seeing established payment facilitators who suddenly want to own processing. We're seeing fintechs who have a really prevalent payments part of their operation who don't want to rely on a traditional acquirer's processing capability. We're even seeing global merchants who want to own more and more of the stack because it all comes down to the customer experience. Why we almost look at it like, why not rely on a technology partner to own the technology? Because they can be innovative, they can be agile, they can chuck prioritization far more easily, and they let the acquirer do the compliance, the risk, the settlements, and you combine those two, and suddenly it's a really interesting proposition.
It's something I actually love about the industry and what you've just described, that opportunity to take, to not just think creatively, but to actually innovate in a systematic way that actually leads to multiple wins. That's just that's almost a case study of payments at its best. And so I could see why the uptake's going to be so strong on that, maintaining the competitive advantage, as you said there, but actually reducing by probably down by 5-fold the actual go-to-market and actually. So no, brilliant product, and I wish you well with that. So that sounds exciting and so value added to many parts of the industry.
Thank you.
So Esme, just what excites you most about the payments industry as you look over the next sort of 12 to 18 months or so?
Yeah, I think there's been a lot of flux in the payments industry, and I think 21, 22 talk, record multiples, but I think there was a lot of value for people were valuing companies that straddled multiple industries and multiple parts of the product chain. And I think the effect of that is now you've got kind of not necessarily leaner companies, but companies which are laser focused on doing one thing and doing that thing very well. And then you've got the emergence of product class specialists rather than people kind of doing a bit of everything and not doing anything
Right.
super well. So I think that's exciting because that unlocks new areas of innovation. As Phil just said, the Shift product, cash flows are acquiring, focus on the acquiring side, and this is them really understanding that side of the value chain. Has allowed them to actually really re-innovate, the flows, which, I've been working in payments a long time. I've never seen this before, and it makes a ton of sense from all parties. So I don't know why more people didn't do it. And I think it might be potentially having that kind of clouded focus across multiple different areas, disallowed people just focusing on smaller parts of the chain, which has been a hindrance to innovation recently, but I'm really excited to see where it goes.
Excellent. Do you mind? So this is the time where I normally bring together what I've heard and what I think could be most salient. So, but I've got pages of notes here, so I'm just going to try and go with probably the most prominent elements. I think the real fascinating thing today that I've heard, and I'm hoping our audience sort of appreciates this as well, is about what the value here of framing and clearly understanding what the role of an investor is, and then what the role of the portfolio company is. Naturally, the role of the investor is obviously to bring funds and to bring capital, yet to bring what I call a collective knowledge and an accumulated knowledge from different industries and different places, but also to bring a network and to bring, and also to bring an appropriate level of challenge. Naturally, from the portfolio company, they're there to deliver, to run the business as most effective as you can, and be reciprocal to taking advice, taking challenge. But I think the real crux of that is building a mutually trusted relationship where we've actually all got the same goal, but we don't necessarily always having the same goal doesn't mean we're all going to go in the same direction. And I think something that, well, we all know in the payments industry, as trust goes down, transaction costs go up, and vice versa. And so therefore, I think the one thing for me as well I observed was that psychological safety is important, and respect is important before trust is built over a period of time. But the fact that actually we're going on a journey together here. We're not going to be doing this for 5 months. It's far more likely to 3 or 5 years, depending on what that expansion story can look like. And I think what that actually creates is an opportunity for true innovation, as we've just described with the Shift product, which is actually doing what the payments industry does best, which is finding a very narrow, appropriate niche, solving a significant problem, but then having a multiple possibilities of winning at scale, and then reducing cost to marketplace, etc. So I think the big takeaway I'm getting today is the payments industry is the payments industry. It's an ecosystem, and you can't do anything of any scale on your own. Everybody needs to play their appropriate part, respect and trust that other people are going to play their part. And when they do that, you've got an opportunity to have growth and learning based on curiosity, and also each person and each part doing the role they should be fulfilling and not going in with the role they shouldn't be doing. So I'd love to leave the final thoughts to yourself to add.
Yeah, I think kind of my final thought there is, while it's really big in terms of volume, in terms of people, payments is really, really small industry. So I think, everyone's a prospective partner, even, your competitors, and if it's not today, it might be tomorrow. So I think kind of learn from everyone, collaborate where you can, because it is kind of a shared knowledge industry.
Yeah, I'd absolutely echo that. I think there's a huge opportunity that we have, and I think we're only going to succeed by the continued relationship we have with Pollen and all the benefits that come with that. It only enhances the opportunity we have and how quickly we can execute on it.
Well, I just want to say thank you so much for your time and your focus today. I really do appreciate it. And what a wonderful way to finish, which is remind us just how small the industry actually is. Thank you.
Thank you.
Thank you.